Good morning, everyone. Today's webinar session is on FEMA rules and regulations for setting up of joint venture, wholly owned subsidiary, and step-down subsidiary. The regulations for setting up of the JV or wholly owned subsidiary and step-down subsidiary is given in FEMA Foreign Security Transfer or Issue Regulations 2004, and it was amended from time to time. See, to understand why this session has been chosen at this time, it is very important if every one of us will be aware that the pandemic, which currently is spread across the globe, has taught all the SMEs and other business people the hard way that the diversification of your supply chain as well as your market is very, very essential, and especially for those SMEs and business class people who have their business dependent on the international market, either from the supply side or from the market side. So, as you're all aware, in the news, it's very prominent these days that once China was locked down completely, a lot of supplies are cut down, and most of the businesses could not even continue their operations because of lack of supplies. So that has made it very clear that going forward, to survive, the business class has to expand, or they expand or look out for a second line of supply or markets. They can't just simply depend on one market or one supply chain. So this pandemic also poses an opportunity to acquire a business and diversify those businesses which have surplus cash or they have deep equity now. They will be able to acquire businesses and diversify their business, especially in the IT sector. Most of the companies are trying to acquire other companies which are in the different line, though in the IT sector itself, they are in a different line to diversify their business. That has become very prominent now. So in such scenario, it becomes very, very important to understand the FEMA regulations with regard to setting up of the joint venture or the wholly owned subsidiary or step-down subsidiary. And because the structure of the group essentially will change now, and most likely in most of the cases it will change because of the plan for diversifying their supply chain or their market. So in this regard, it will be critical to understand the FEMA regulations. So before this start, what I would like to make clear is this regulation is quite lengthy. That is, the transfer issue of foreign security regulations is quite lengthy. It covers various topics of the various entities. Today's in this session, we have taken a limited part of it and trying to cover most critical part, or the very basic part of it is being covered. There are a lot of other things like the regulations for trust societies, and then once you set up the role of guarantees, and in some special sectors like oil, and there are separate regulations for all these things. So those things will be covered in the subsequent sessions. Today's session will cover the basic or the definitions and the important regulations that has to be followed to set up the wholly owned subsidiary or step-down subsidiary alone. Okay, and in the specialized category today, we have additionally covered the financial services as well. What is required to set up a financial business of financial services abroad. So first, before starting this, I would like to thank Subhash and Bharati for their efforts to getting this presentation ready, and more importantly, even Meenakshi for her views on the presentation which you have prepared. And very simple legends, nothing much complicated here. Most of us should be aware of all these things. As I said, we have covered only specific regulation. We have not covered the entire regulations here. So we'll look at, as we've already covered, that why it is required to look at these regulations now. And second, we will be looking at the definitions, which is very, very important. and then we'll look at the setting up of JV and wholly owned subsidiary. What are the regulations available for it? One from a corporate entity point of view, and others from individuals point of view. And what is the meaning of step-down subsidiary? And what are the levels of step-down subsidiary? And then how to set up a step-down subsidiary, and the reporting, very basic reporting part will be covered in this session. First of all, the relevant definitions. The most important one are the definitions of wholly owned subsidiary, joint venture, and direct investment and Indian party. Those are four critical definitions. There are other definitions as well, but that we'll cover going for once we proceed with the other sections. The wholly owned subsidiary, the definition as per the regulation is, they have said that a foreign entity formed, registered, or incorporated in accordance with the laws and regulations of the host country whose entire capital is held by the Indian party. So this definition with the plain reading throws up 3 points here. One, it is any foreign entity. It need not be only a company. It can be any foreign entity. It could be LLP or a partnership firm registered abroad. Okay, but it has to be registered and incorporated. Unregistered bodies are not covered under the WOS. And then second is it has to, they have said it is the entire capital. They have not defined the word capital. We'll see the issues again going forward. And then it is held by the Indian party. And this is the Indian party definition will also be covered in the next slide. And similarly, next, when we come to joint venture, here as well it is any foreign entity formed, registered, or incorporated in accordance with the laws and regulations of the host country in which the Indian party makes a direct investment. Here, additionally, they have used the word direct investment here. We'll cover what is direct investment. The direct investment outside India means investment by way of contribution to the capital or subscription to the memorandum of association of a foreign entity, or by way of purchase of existing shares of a foreign entity, either by market purchase or private placement or through stock exchange, but does not include a portfolio investment. We'll look at what is it once we cover the definition of the Indian party as well. The definition of Indian party means a company incorporated in India, or a body created under an act of parliament, or a partnership firm registered under the Indian Partnership Act, a limited liability partnership, or making investment in a JV or a wholly owned subsidiary, and includes any other entity in India as may be notified by the Reserve Bank of India. So now, once you have seen the basic definitions, the plain reading of the definitions throws up various points. So once I'll come back to again to the definition of wholly owned subsidiary. The plain reading of it says that it is only for when you hold the entire capital is held by the Indian party. As we have seen, the definition of Indian party does not include an individual. It does not. It could rise give up doubt that whether the Indian individual is resident individual is allowed to invest or not. It is worthwhile to note that the Indians resident individuals were allowed to invest abroad in ODI only in the year 2013. So the definition was not changed at that time, but it will be pertinent to note that the RBI, in its part, and while clarifying the facts and inquiries, it has stated that it will also include the, as I said in the last point of this slide, it's mentioned that in the facts and while clarifying for facts and inquiries, the RBI clarified that the wholly owned subsidiary also includes investment by an resident Indian. So, but the definition as such was, the wordings of the definition has not been changed since it was drafted much before. But the individuals were provided the permission to invest only in the year 2013 by notification on August 5th. Okay, and that is so. So, in the case of wholly owned subsidiary, the other important point to be noted is the definition of Indian party does not mean to include only one party. So even 3 or 4 Indian-based companies and along with the resident Indian, if they invest in a wholly owned subsidiary, that is in a company outside India, and if the entire shares held by either the Indian company or LLP or the Indian resident, all the parties, the Indian parties, all of them put together will be treated as an Indian party. So even if 3 or 4 people, four entities and one individual put together, they invest in a company abroad, it will still be treated as a wholly owned subsidiary of each of these party. So it is very essential to note that it need not be it is not necessary that all the complete shares of the foreign company should be held by one party to be deemed as wholly owned subsidiary. It is sufficient that if all the shareholders of the foreign company or the foreign entity is Indians, that will make it as a wholly owned subsidiary of each of the Indian party and the resident Indians. So now coming to JV. So once having understood what is meant by wholly owned subsidiary, it's simple to understand, much easier to understand what is meant by JV. So since we have already covered in wholly owned subsidiary, stating that if all the shareholders are Indians or Indian registered companies or resident Indians, it becomes a wholly owned subsidiary of each of the every party. And now, in case in the shareholding of the foreign entity, if one person, one entity is of a foreign domicile, then it will become the JV of the Indian of each of the Indian party. So here, say if there are 5 shareholders of the foreign company and 4 of Indian domicile-based shareholders, one person is foreign domicile person, then it becomes a JV of the 4 Indian parties. So if one foreign shareholder is involved, it becomes a JV. If all the shareholders are of Indian origin, Indian resident or Indian domicile person, it becomes a wholly owned subsidiary. Because it is very critical to understand this fact here. And then while coming to the point of capital, the term capital has not been defined under FEMA. Okay, so but though it has not been defined, but in regulations pertaining to write-off of capital, the regulations have indicated that capital includes both preference shares as well as equity shares. So it is the entire shareholding has to be held by the Indian party and Indian resident for it to be called as a wholly owned subsidiary. Okay. So in case of direct investment, they have given multiple options. That is, one, should have the Indian party or the Indian resident should have contributed to the capital, and it need not be. There are 3 options for investing in the foreign company. One, you can, at the time of setting up the company itself, you can subscribe to the memorandum, or make a private purchase can be done, or through shareholder in the share market you can purchase it, but it does not include the foreign portfolio investors under the direct investment definition. As I said, the definition capital covers both preference as well as equity shares, and as I said, and then the difference between the JV and wholly owned subsidiary has already been explained. So if there is one foreign party, it becomes a JV of all the Indian parties, and if all the shareholders are Indian parties, is a wholly owned subsidiary. And the JV definition, if you see as per FEMA, there is no requirement, or they were not specified the words control or need of control on the foreign entity and all. But whereas when you see the accounting standards, they said it has to be jointly controlled for definition to fit into the term JV. This has already been covered. So now coming up to setting up of JV or wholly owned subsidiary, there are both for the Indian party as well as the Indian resident. There are 2 options available: one under the automatic route and one under the approval route. So approval is where you get an prior approval before investing. Automatic route, just intimation is sufficient. So now coming to the regulations which are applicable for Indian party while setting up an JV or wholly owned subsidiary abroad. There are some conditions that have been given here. These conditions have been specified under Regulation 6. So now the first and foremost important condition is the financial commitment of the Indian party in the JV or wholly owned subsidiary should be less than or equal to the 400% of its net worth of the Indian party as on the date of the last audited balance sheet. So now, and second, the other important conditions are the direct investment is made in a JV or wholly owned subsidiary engaged in bona fide business activity. It has to be a legal one. It cannot be illegal business. And second, the Indian party is not in the RBI's export caution list or list of willful defaulters by any of the credit agencies. And then all transactions relating to the investment in the JV or wholly owned subsidiary are routed through only one branch of an authorized dealer. And investment is not made in an entity which is under the non-cooperative list given by the FATF. Currently, only Iran and North Korea are there in that list. And so now coming back to the in detail analysis of these conditions, the first point and first and foremost point is about the financial commitment. When you see that in the there are two parts to it actually. One in the definition section in the regulation 2, if you see where the definitions are given, it has been mentioned that financial commitment includes equity, loans, or 100% of the guarantees and 50% of the performance guarantees given by the Indian party to its JV or wholly owned subsidiary. So when the plain reading, in the definition part, it has been said only equity. So it is not covered in the definition CCPS, that is the preference shares part. But when you come to the regulations, under the 6 regulations, when you come, that there they have clearly mentioned that it also includes CCPS. So here it becomes very important to note that through notification in the year 2012, the RBI has clarified that CCPS will also be covered under the definition of equity. So they have not changed the definition in detail to include the CCPS as well, but the separate notification has been issued in the year 2012 to include even CCPS as part of the, it will be treated at par with equity. And hence the definition has not been, the wordings of the definition has not been changed. But when you go to the regulations in detail, even at point by point, there they have made it clearly mentioning that equity also include equity, CCPS, loans, and 100% of the amount of guarantees and 50% of the performance guarantees issued by the Indian party will be covered under the financial commitment. And one important point is here the 50% of the performance guarantee is being given. So what happens when you are giving a guarantee, or when you're when the guarantee is being enforced? In such case, that means it will be absolutely for the 100% of the amount. But while calculating for the financial commitment, they first in the initial stages they will take only the 50% of the part. But when it is being enforced, and if at all, because of the enforcement of 100% of the performance guarantee, the financial it exceeds the 400% of the net worth clause, then at that time the approval of RBI is to be obtained before honoring that guarantee. So that is very critical point here. So at the time of just investment, for the investment purposes, it will be only you have to see the levels of only 50% of the performance, consider 50% of the performance guarantee while calculating the limit of 400%. But once it is being enforced by the other party, in such case, while honoring that guarantee, if the 100% of, while including that 100% of performance guarantee value, if the financial commitment goes over and above 400%, then in such case the permission of the RBI is to be obtained before honoring that guarantee. And second, the other important point is, in case of all transactions relating to the investment in JV or wholly owned subsidiary are to be routed through only one branch of an authorized dealer. Here, as we discussed earlier, there could be 4 or 5 parties investing in the foreign entity. So in such case, all the 4 entities have to go through only one authorized dealer, one branch of the authorized dealer. It's not that the one branch of authorized for one individual investee separately. It is for all the Indian parties put together. For that investment in the wholly owned subsidiary abroad, it has to be only one branch of an authorized dealer. So if there are 4 parties who are involved, jointly put money in the WOS abroad, all the 4 parties should use only one branch as an authorized dealer for this purpose. So once and now going to the next. Yeah. So these are the basic conditions that has been said in that regulation 6. Now coming to the when the Indian party wants to do a financial service business abroad. So that is, there are separate guidelines, that's additional guidelines that is being given in this regulation here. These guidelines are in addition to the guidelines earlier conditions which you have seen in regulation 6. Okay, the financial services shall, first we'll look at the definition of financial services. The financial services shall mean services rendered by banking and non-banking companies regulated by the Reserve Bank, insurance companies regulated by IRDA, and other companies regulated by any other financial regulator like SEBI. So all these are the come under any entity which is regulated by these financial regulators, whether it is RBI or IRDA or SEBI. All the whatever service they are providing under that, it will come under the purview of financial services. So whichever entity wants to invest in a foreign company in the business of financial services, the additional conditions has to be satisfied. One, it should have earned the net profit during the preceding 3 financial years from this activity. The company could have other segments. It does not matter whether it has incurred loss in other segments, but from the financial services activities, it should have earned profit in the last 3 years. Okay, and then it is registered with the appropriate regulatory authority in India or conducting financial services activity for conducting financial service activities. Okay, and then it should have also obtained uh, regulatory approvals from both the parties in India as well as the regulators in India as well as abroad before placing the application with RBI. Okay, and then the entity should have sufficient amount of capital as required in the prudential norms of the respective regulator. And it should be noted that these regulations are not only applicable at the time of investment in the JV for finance, JV or wholly owned subsidiary for financial services. These are applicable even when you are investing in any other step-down subsidiary in the financial services sector. So every time when you are making any investment, irrespective of whether it is wholly owned subsidiary or step-down subsidiary or JV, anytime if the investment is being made for the purpose of financial services business abroad, all these conditions has to be satisfied each and every time. Okay, and these conditions are cumulative along with the section 6, the regulation 6 conditions considered in the previous slide. Yeah, so now we have seen what are the conditions in regulation 6 and 7. So now we'll see what are the cases or instances where the financial the Indian parties should go through the approval route. As stated earlier, there are conditions given, 2 sets of conditions, one for financial services, one for other businesses. So any of the conditions if it is not satisfied, obviously it cannot go under the automatic route. It has to go to the approval route. In addition to this, following the other following instances, it has to compulsorily go through the approval route. So in that first condition is investment by any registered trust or societies or for doing business abroad has to go to the approval route. They don't have an option of automatic route. And then investment by a proprietary concerned unregistered partnership firm has to again go through a approval route. As we have seen earlier, in the definition of the Indian party, only the registered partnership firms have been considered. So here the unregistered partnership firms have to mandatorily go, even though they're satisfying all the conditions in regulation 6, these entities have to go through the approval route only. And then investment in foreign entity engaged in real estate. So here it is pertinent to look into the definition of what is meant by real estate. So real estate is about buying and selling of real estate, that is land or parcels of land, and transferable development rights. But however, the investment in a company which is involved in construction of buildings or bridges or any infrastructure projects, it will not come under the ambit of the real estate business. So it is outside the ambit of real estate business. So any investment for these businesses, for example, development of townships or construction of buildings abroad, can go through the automatic route. Only if it is for buying and selling of only parcels of land and the development rights, if you're trading in that, then in such case it has to go to the approval route. If you're going to only do construction of only construction works there abroad, then it can go through the automatic route. And then any financial commitment which exceeds USD 1 billion or its equivalent in any financial year. So irrespective of whether you satisfying all the conditions in regulation 6 or 7, if the total value of ODI investment, and that is including the other financial commitments, exceeds USD 1 billion, the approval of RBI is to be obtained in such cases. And then financial commitment with equity contribution. So without equity contribution, if you are going to make only give any loans, or without equity contribution, if you are going to extend loans or guarantees, then in such case, it has to go to the approval route. Only if you have equity investment abroad in the wholly owned subsidiary, only in such cases, you can extend the other financial commitments like loans or guarantees can be given. If there is no equity contribution in the foreign entity abroad, then for giving extending any loans or issuing any guarantees, it has to take the approval route. See, one important factor here is, for example, in India, if you see the ECB rules for taking any accepting any external commercial borrowings, it is mandatory for you can only borrow it from persons who have equity investments. So similarly, if such conditions are there in the rules as per the host country as well, you will not be able to do. Even for while going to the approval to RBA, even before that, you should ensure that such restrictions are not there in the host country. Only then you can apply for approval with RBI. If there are similar conditions, similar restrictions as in India, where you cannot accept ECB from one party which does not have equity investment, then there is no question of going for an approval to RBI. Okay, and then the foreign entity, wherever it is investment or the investment in foreign entity is being made, which does business in Indian rupee linked derivatives, in such cases, the approval of RBI is mandatory, irrespective of satisfying the conditions under Regulation 6. And next comes the acquisition or setting up of JV or wholly owned subsidiary by the resident individuals through automatic route. As I said earlier, the resident individuals were permitted to invest abroad only in the year 2013, dated August 5th, through a notification. Okay, so for them, the conditions under Schedule 5 has to be met for the investing abroad. So these are the list of conditions. Some of them are very simple, and the first one is the investment is not in a JV or wholly owned subsidiary, which is engaged in the real estate business or banking business, or in the business of financial services activity. The same is prohibited. See, here there are some 6 or 7 or 8 clauses under Schedule 5. It is pertinent to note that in some of the clauses, the RBI has used the word "it is prohibited." In some cases, it has just said that it has to be only in this one. So wherever it is prohibited, the approval option is not even available. So where it is been stated that under this schedule it cannot be done without the beyond this. In such cases, when that condition is not met, the it can be interpreted that you can adopt the approval route. Okay. The next condition is resident individuals shall not be in the RDS exporters caution list or list of defaulters by any of the credit agencies. Because anyone who is marked as willful defaulter in any of the credit agents by credit agents like CIBIL or Equifax or anyone can will not be permitted to invest abroad. And investment shall not be made in entities located in the non-cooperative list issued by FATF, as we already discussed in the case of Indian party as well. The same condition is applicable, so that wherever the you cannot invest in countries which are there under the non-cooperative list. And then the limit of 250,000 USDs mentioned under the LRS scheme still applies. You cannot exceed that limit. So all the foreign exchange drawings put together in a year, whether it is for current account purposes or for this ODA purposes. For an individual, it cannot exceed 250,000 USDs in a year, in one financial year. So in the next financial year, if the limit is exceeded, the transaction can be done in the next financial year. However, as already said, the exchange earners, that is foreign exchange earners account or drawings from the resident foreign currency account will not be counted for calculating the 2,50,000 rupees of limit. If you have additional funds in the RFC or EFC account, that can be used over and above the 2,50,000 limit specified under LRS. Okay. The JV or wholly owned subsidiary acquired or set up shall be an operating entity only, and no step-down subsidiary is allowed to be acquired or set up by the JV or the wholly owned subsidiary. So in this case, as I said earlier, in this clause under Schedule 5, the word term prohibited has not been used. So it can be interpreted that for the purpose of this clause, when you want to do it under the automatic route, this condition has to be satisfied. If this condition has not been satisfied, you can still take the approval route. Here there are a couple of interesting points or important points to be noted. One is the JV or wholly owned subsidiary acquired or set up shall be an operating entity. See, in the case of this condition is not specified in the case of an Indian party. See, what is meant by an operating entity? That has not been defined, but when you read the other regulations or other provisions in the as part of this regulations, it's very clear that where it is investment is through an SPV, it is not allowed under automatic route for the individuals. It is allowed for the Indian party. So Indian parties can invest abroad through an SPV, but the Indian resident cannot invest abroad through an SPV. He has to directly invest in the operating and the entity which is doing the business. He has to directly invest in it. The Indian resident does not have the permission to invest through an SPV in the case of automatic route. It has to go to the approval route. So in the same way, in this clause, additionally have said that the JV or wholly owned subsidiary shall not set up or acquire a step-down subsidiary. So in the case of an individual, once he invests in a wholly owned subsidiary under the automatic route, he will not be able. The JV will not be permitted to invest in the one more step-down subsidiary. We'll see that what is meant by step-down subsidiary in the subsequent slides. And then, in the case of a resident, the investment shall be only in terms of direct investment in JV or wholly owned subsidiary, and no other financial commitment is allowed. It is explicitly prohibited. So that means the resident individuals can invest only in either the, as we have seen earlier, direct investment means only capital part. Okay, so in that capital as well, only they can invest in either equity or CCPS under the automatic route, or even here the approval is not even available, since it is explicitly prohibited by the RBI for an individual to extend any other kind of financial commitment, that is loan or guarantees or personal guarantee performance guarantees, cannot be given by an individual to his JV or wholly owned subsidiary or step-down subsidiary or whatever it is. So only the direct investment in equity and CCPS is being allowed. And here it is very important to note that the individual, in his capacity as a promoter of the Indian party which has a JV or a wholly owned subsidiary abroad, can give a personal guarantee on behalf of the JV or wholly owned subsidiary of the Indian party. So here it has to be carefully noted that in case if the individual invests in his individual capacity in a foreign entity, he will not be allowed to give guarantee or loan to the JV or wholly owned subsidiary. But in his capacity, if the Indian party, that is a company or LLP, invests abroad, and the partner or the shareholder of or promoter of that company or the LLP can, in their capacity of the promoters of the company or LLP, will be allowed to extend guarantees to the JV or wholly owned subsidiary of the Indian party. So if it is an individual, he cannot do it, but in his capacity as the promoter of the Indian company which has invested abroad, he'll be allowed to extend guarantees. So this becomes very critical in terms of while finalizing the structures of the group of the SMEs, where the long-term planning about the source of financing has to be decided, okay, upfront or thought through while setting up this structure. And once we start doing it by the individual names and going forward, you require to raise some funds by giving guarantee, then the individuals will not be allowed. That's where the structuring becomes very, very important, or what route you take up becomes very, very critical in ensuring that finance is available at the requisite time for the JV or wholly owned subsidiaries abroad. Okay. So any of these conditions, if it is, as I said, not the condition which has not been prohibited, if they are not satisfied, approval route can be taken. If the conditions which are prohibited are not satisfied, you cannot go under the approval route as well. Okay, so only the conditions for so especially that option is available only in the case of setting up of an operating entity and setting up of a step-down subsidiary. That option for going under approval route is available. In all the other cases, the individual cannot has to mandatorily satisfy these conditions. And when these are the points which the RBI will consider when approving your application for under the approval route. One is the prima facie viability of the JV or wholly owned subsidiary outside India. See, at this point, it is important to note that without the permission of RBI, you cannot book a loss or write off your investment in your asset. So while going through approval, they don't want the Indian party or the Indian resident to write off their investments. So they will analyze the profitability and the viability of the venture abroad before giving approval. So in that case, it becomes very important that the business plans and all are in place to convince RBI stating that this business is viable. Otherwise, if there is no proper business plan is in place, and you are not able to convince RBI of the profitability or viability of the business, then in such case, getting approval will be quite tough. And contribution to external trade and other benefits which will accrue to India through such investment. Obviously, once the RBI permits, it expects some benefit of accrual of foreign exchange or other benefits for the economy as a whole. So it is that also will be considered. And then financial position and business track record of the Indian party and the foreign entity. If it is an already an existing entity which you are investing, then the track record of that entity will also be looked into. And in the case of the applicant as well, his track record, his business profitability, existing business, source of the funds, all will be looked into while giving the approval. And the expertise and experience of the Indian party in the same or related activity of the JV. So whatever business you're going to invest, you should have a prior experience, or you should have the team in place which has quite good experience. And now coming to the interesting part of setting up of step-down subsidiary abroad. See, it is important to note that the term step-down subsidiary has not been defined either in here or in any other act. But we have and even in the case of FEMA, the definition of even subsidiary has also not been defined. Okay, but when we go to the Companies Act, as I said, where you have the right to control the composition of the board of directors, or you exercise more than 50% of the voting power. In such case, it will be treated as your subsidiary. This part becomes critical because, as I said, in the case of an individual, the individuals, in the case of individuals, the JV or wholly owned subsidiary is not allowed to set up a step-down subsidiary. So that's where it becomes critical to understand what is meant by step-down subsidiary. So now, since there is no definition under FEMA, and we are just looking at the definition of subsidiary as per the Companies Act. So in such cases, what happens is now we have to deem that the the foreign entity, if it holds more than 50% of the controlling power of the other entity, then only the entity down the line will become as a step down subsidiary. If it does not hold the controlling more than 50% of the controlling power in the entity, step down entity, then it will not be treated as a step down subsidiary. So this becomes critical in again the setting up the structure. As I said, it has not been, the definition of step down subsidiary has not been given in FEMA, and even in the Companies Act, they have defined only subsidiary. They have not defined step down subsidiary. But in one of the cases under the Income Tax Act, they have the step down subsidiary. They have considered they have defined given explanation to step down subsidiary, saying that it will be step down subsidiary will be the subsidiary of the subsidiary. So there is no definition as such in the fine print. And now, so having understood what is meant by the step down subsidiary, okay, now it is critical to understand what are the levels of subsidiary, because there are implications for that as well. So what is the first level of step down subsidiary and what is second level of step down subsidiary? So now in this case, as I said, this also not been defined or here. It is based on the regulations, reading of the other regulations that has been put in place. So there is an Indian party A here, and it has a JV abroad. So it could be, it need not be only a JV. It can also be, you can consider either way. It could be JV or a wholly owned subsidiary. It invests in that B Limited abroad, and then the B Limited again invests in C Limited with more than 50% of the control. Then in such case, C will become the first level of step down subsidiary of A. Okay, and in this case, even if you substitute A Limited with the Indian resident as well, in such case, still B will be treated as a JV or wholly owned subsidiary, and then C will be treated as the first level subsidiary, step down subsidiary of A. And then limit of step down subsidiaries. See how many step down subsidiaries can be factored in a structure, that is critical. But in FEMA, they have not given any guidelines. But in Companies Act, it has been mentioned that you cannot have more than 2 layers of subsidiary, both under the rules of restriction on number of layers as well as in the main section 186(1) as well. It has been given. However, it is to be noted that since in the Company Act itself it has been mentioned that these rules shall not affect a company from acquiring a company incorporated outside India with subsidiaries beyond 2 layers. If it's already in place and you are acquiring a foreign company with layers of subsidiaries, then it is not prohibited. In the current scenario which we are exploring here, the investments are going to be abroad, so it becomes critical to understand the regulations of corporate relations of the host country, whether it is allowed to have more than 2 layers of subsidiary in the country which the proposal is there to invest. So as per the Companies Act, it's only for applicable for Indian this one. But when you are investing abroad, you have to look at the corporate relations of the host country for the limit on step down subsidiary. FEMA has not given any prescribed any limits on the number of layers of step down subsidiary that can be had. And then, as I said, the options available for setting up of step down subsidiary. There's one, the Indian party has both two routes, or automatic route and approval route. And for a resident, as I said earlier, and a schedule for an automatic route, the option of setting up of step down subsidiary is not available. So individual, whenever the step down subsidiary of is to be set up for the investment made by the individual, it has to go through the approval route. There is no option of automatic route here. And now we'll look at the provisions for setting up of a step down subsidiary abroad by a joint venture or wholly owned subsidiary of an Indian party. Under the, as I said, the regulation 13, it is automatically provided to. There's no restriction for the Indian party to invest the JV of the Indian party to set up a step-down subsidiary below it. But and whatever regulations are given in regulation 6, it is applicable only for at the time of the Indian entity making investment in the JV or wholly owned subsidiary. When the JV or wholly owned subsidiary is making an investment in the step down subsidiary, there is no regulations or under FEMA. Okay, obviously it is because it's going to be in the foreign country. The regulations prevailing there will be important, will be critical there. And in the case of approval route, in the following case, in the case of the following transactions, approval has to be obtained by the Indian party from RBI. So now, just in the previous slides, we discussed what is meant by first level subsidiary and what is meant by second level subsidiary. That becomes critical in this case here. So in the case of corporate guarantee to be issued by the Indian party to the second and subsequent level of step down subsidiary. Okay, there is. I'm reading it to the point that it is the corporate guarantee issued by the Indian party to the second and subsequent levels of step-down subsidiary. That is what requires the approval of RBI. If the corporate guarantee is given to the first level step-down subsidiary, no permission of or RBI is required. You can do under the automatic route, provided that the overall limit of financial commitment is met. That it has to be all the guarantees put together, whether it is given to the subsidiary, it is the wholly owned subsidiary or the first level step-down subsidiary. All of these things put together should not exceed 400%. And only in the case of the second level of step-down subsidiary, the permission from RBI is to be obtained. In the case of first level step-down subsidiary, when the Indian party is extending a guarantee, there is no requirement of to take up the approval of RBI. And one very important point is RBI will consider the application for approval for extending corporate guarantee to second level subsidiary only if the Indian party holds an indirect investment of around 51%. So it should have an indirect control through its JV or wholly owned subsidiary and first level subsidiary to the extent of 51%. Otherwise, if the indirect holding falls below the 51%, there is no question of even applying for approval. It is completely prohibited. Okay, so the direct investment in so the whatever conditions are there in section 6, that has to be, if it is not followed, it has to come to the approval route. So now the question of step-down subsidiary for individuals. As I explained earlier, when the individual resident Indian invest in a foreign entity, that will become the subsidiary, wholly owned subsidiary or JV, and any entity below it will become the first level step-down subsidiary for the resident Indian. Okay. So in this case, as we already discussed, resident Indian does not have option of going on the automatic route. It has to go through the approval route. And the approval has to be again through the AD by filling up the the ODI form. Okay, and here, as I already said, the even the approval route, even in the case of if not being an operating entity, if the Indian resident is going to invest through an SPV, then also they should follow the approval route. These are the examples, some of the examples for the various routes, automatic route and whichever falls under the approval route. So in this case, we have considered a case where there are three Indian parties, all of them are companies. So obviously, it will, the delimited is there in a foreign entity that becomes a wholly owned subsidiary of these three entities, and any investment in subsidiary 51% or above, that becomes under the since it is Indian party is allowed to invest under automatic route in a step-down subsidiary, there is no approval required. So this will go under the automatic route, this scenario. And in this scenario, we have considered a mix of both the Indian party and Indian resident. and one more foreign delimited being a foreign promoter. So once since a foreign promoter is involved, the E limited, which is a foreign entity, that becomes a JV of all the both the Indian party as well as the Indian president. So any investment in the step-down subsidiary by E limited has to go to the approval route, because since one Indian resident is involved, it has to go to the approval route. And so in the case of in this the Mr. X. So now in the case we are considering the first case, we consider all the three as Indian parties, and second illustration we considered both Indian parties and Indian resident. Now exclusively Indian, all are Indian residents. In such case, obviously it has to go through the, when you are investing in subsidiary B limited, it has obviously go through the approval route. Automatic route is not permitted. And then in the third case, we have considered two Indian parties investing in one wholly owned subsidiary, and then the wholly owned subsidiary invest in a SPV. So here it is pertinent to note that in the regulations, the automatic route is available for the Indian parties only when the Indian party is making an investment in a wholly owned subsidiary through an SPV. If an wholly owned subsidiary set up SPV for further investment, this has not been listed. This scenario has not been listed under the automatic route. So, in such cases where the wholly owned subsidiary is setting up a SPV for further investments down the line, it has to go through the automatic route. So, I'm reiterating the point that under the automatic route for the Indian parties, permission is available for setting up an SPV and then setting up a wholly owned subsidiary. But whereas in a case where Indian party invests in a wholly owned subsidiary and then it sets up a special purpose vehicle to hold investments, so the SPV is not an operating entity, and if it is going to further invest down the line in another operating entities, in such case the approval of RBI is to be obtained. And reporting procedures for setting up a step-down subsidiary. So once it is decided that it is to set up, even in case of automatic routes, once it is the board has approved, or board of the wholly owned subsidiary approves setting up of a step-down subsidiary, it has to be intimated within 30 days to the RBI, and the performance of the step-down subsidiary is also to be included in the annual performance report filed with RBI every year, along with the APR of it should be included as part of the performance of the wholly owned subsidiary or JV, which the Indian party will be filing every year. So now, having seen this, having seen all the clauses here, so here one other option that is available for one critical aspect in case of individuals setting up, wanting to set up entity down the line below the wholly owned subsidiary. As I said, the definition of step-down subsidiary has not been provided under FEMA. That is where we have referred to the Companies Act and deemed that it is the if the wholly owned subsidiary holds more than 50% of the controlling interest in the entities down the line, it will be treated as step-down subsidiary of the of the JV or WOS. So in such case where the Indian resident has invested in a WOS, and if it wants to expand further or set up layers below the WOS, since it is not provided under the approval is not available on the automatic route, instead of going to the approval for RBI, there are option is where you can if the wholly owned subsidiary set up by the Indian resident can hold less than 50% of the layer below it, then in such case it will still go through the automatic route, and approval would not be required for the Indian resident. So only in case where the wholly owned subsidiary set up by the Indian resident is going to hold more than 51% or 50% in the layers below it, that is when the approval of RBI would be required. So if it is going to be less than 50%, can still go through the automatic route. This is one of the options available. So having seen all the regulations, especially the restrictions in terms of the extent of financial commitment that an individual can make, and mostly the SMEs which were closely held by the individuals, while structuring the group for them, it becomes very critical to understand these points, and the structure has to be put in place, keeping in view the long-term requirements of the funds for the wholly owned subsidiary abroad. So it is obviously going to be funded by the parent here most of the times, unless till the time it becomes self-sufficient. So it becomes very, very critical in understanding these points. So the other regulations, as I stated earlier, the other part of the regulations will be covered in the subsequent sections. If you have any doubt, you can just mail us to at research@dvsa.com as well. And even if you have any other viewpoint, different viewpoint on the interpretations which you have made, you can write to us at research@dvsa.com. We'll be more than happy to consider it. Thank you.